Welcome back, investors, to Ticker Time News. I'm Adam. In Gap, ticker symbol GPS, Gap shares continue to gap down lower after Morgan Stanley downgraded the stock, citing ongoing margin pressure for the year. The stock's price has been beaten down recently amid difficult conditions, having declined by about 38% over the past 6 months. Intensifying supply chain issues have weighed upon the clothing retailer's performance. Concerns have also been growing for Gap's peers. For example, earlier in the month, Abercrombie and Finch, ticker symbol ANF, lowered the midpoint of its quarterly revenue guidance to 1.18 billion from 1 to 3 billion due to increasing unexpected and uncontrollable inventory delays fueled by COVID-related disruptions. Meanwhile, various other clothing retailers, such as American Eagle, ticker symbol AEO, and Levi Strauss, ticker symbol LEVI, have seen their stock prices tank in recent months. Nevertheless, Gap's supply chain headwinds have been especially pronounced, as highlighted by its shares' significant underperformance relative to most of its peers. Supply chain issues were in full tilt during Gap's most recent quarter, evident by the company's sizable EPS and revenue miss. Also, despite considerable same-store sales growth of 5% in Q3, Gap's most prominent brand, Old Navy, which accounts for about 54% of fiscal year 21 sales, saw negative 9% comparison growth. The company attributed the lackluster result to inventory delays and having to resort to air freight to get enough product on shelves for the holiday shopping season. A huge component of Gap's business comes from Vietnam, and commentary from other companies with notable Vietnam-based operations, such as Nike, ticker symbol NKE, and Williams-Sonoma, ticker symbol WSM. It could take until Q2 before inventory issues start to improve. Gap's supply chain woes are all the more troubling when considering the rise of remote work, which is paving the way for a broader shift towards casual apparel. For example, in early October, Levi indicated that it believes that casualization trends accelerated by the pandemic, they're here to stay. It backed its bullish sentiment by pointing to growth in its apparel and denim categories, exceeding pre-pandemic trends. Denim outpaced total apparel for 2 straight quarters. American Eagle in late November also stated that it was seeing casual wear remaining in high demand. Aside from pure clothing retailers, department store giant Kohl's, ticker symbol KSS, is also strategically transforming its business into a leading destination for casual lifestyles as it noticed a shift in consumer tastes. As a side note, Kohl's is currently sitting at the 8th place in our top 10 dividend stocks, or yield leaders as we like to call them. You can get instant access to our top 10 value stocks, growth stocks, dividend stocks, and momentum stocks list by clicking the first link in the description. Now, with Gap, the analyst downgrade is just another thorn in Gap's side. The silver lining, though, is that these issues are largely out of Gap's control, and they could begin to improve as we move throughout 2022. I mean, they should improve, right? For example, the shutdowns in Vietnam have been incredibly disruptive to many industries, but production has continued to ramp up, and companies are optimistic for a full recovery sometime in the second half of 22. Unfortunately, Gap may have already missed out on fully capitalizing on a solid holiday shopping season, lengthening a potential turnaround in the process. Well, that's what I think about Gap's downgrade right now, but I want to hear from you. What do you think about Gap's downgrade, margin pressure, and supply chain issues? And remember, Your comments make these videos so much better. Thank you so very much for watching, and I will see you in the next video.